Hello, friends. Welcome to today's edition of BFF, Brief Finance Funda, brought to you by Ethical Advisors. I just wanted to highlight personally where we all tend to sometimes go wrong in understanding risks associated with shares, mutual funds, and stock markets in general. I think it is important in this context of the shock of the Iran conflict, which most long term investors have heard over the weekend. So, friends, let's understand very clearly however long term we are in our outlook, however intelligent your advisor or your research is, or however much of in depth work we have done in creating a risk portfolio consisting of shares, mutual funds, PMSs, etc. There is one thing which we always tend to ignore or keep on the side, that is called market risk. So, in short, any market related investment is subject to three kinds of risks: one, market risk; two, fund specific risk; and three, timing risk. Let us get these things very clear in short. The market risk is that risk which nobody can foresee. However lengthy you've been in the market, how much ever time you've spent, it is not something which can be predicted. For a simple example, COVID was one of the highest impact negative risks which we have seen. But there are smaller risks. For example, wars, in some cases, a sudden drop in economic activity in a country. So there are lots of unforeseen risks which affect your investments because they are market linked. So these are called market risks. Second, fund specific risks, wrong selection of funds, choosing funds in a sector which has suddenly gone up, or a commodity like gold which has gone up, and you end up coming to the party late when everybody has made money. You end up buying that sectoral fund. That's called a fund level risk. Here it is not going to affect all your investments, but it will affect only those investments where we have made a momentum decision and that decision has gone wrong because that sector has collapsed in the stock market. And of course, the last and most infrequent one is the timing risk. Timing risk means, let's say you have never invested in stock markets or mutual funds and you're a new investor, and suddenly you feel very positive about many factors which you've read about, especially from uneducated or unqualified social media persons or those on Instagram. Unlike advisors who have had a long tail of experience and are licensed by regulators to guide you. So, if you listen or if you're influenced by such decisions and you put everything into equity markets at a time when markets are at all time high, and there is a sudden change of mood globally or speculative profit taking, then the timing risk will make sure that you will lose a lot of money in the short term. How to mitigate these three? Very simple. Please don't do any self research and get trapped. Please consult a knowledgeable advisor with experience. Generally, chartered accountants do tend to play this role, but I'm afraid this is a very specialized function. It's like going to a heart surgeon versus a GP. So make sure that you are in the right hands. More importantly, do check the credentials and ethics of the person guiding you. Never try to say that, oh, I have learned this on a website. Oh, I have seen this on Insta. Oh, I've done a short course and I am now fully qualified to handle my personal finance. Unfortunately, friends, it doesn't work that way. So, market risk being what it is, we at Ethical Advisors always have the right solutions and the right balancing investment products where you can mitigate that, because what is unforeseen will always hit you at some point. Do let us know if we can be of help. WhatsApp us at 99200 34991 and we'll be more than happy to guide.